with those very kind words describing somebody I wasn't sure it was me or somebody else. I'd like to stand on all existing protocols. Let me start by also saying that because I stand the risk of being misquoted, I have delivered a well-written paper to the organizers of this event. However, in order to save time, I'm going to speak from my notes, which I have prepared. The implication of that is that if you quote me wrongly, I will bring out that paper and say, this was Now, it's important that we go back to history. I like to describe the Nigerian capital market today and compare it with a very beautiful young lady who has gone out to the public place, call it a marketplace, thinking how beautiful she was, only to be beaten, battered, with her dress torn, and having to walk home naked from the marketplace. It's going to be extremely difficult to convince that young lady within a very short period of time to go back to that same marketplace, because once beaten, twice shy. The Nigerian capital market today, in spite of all the challenges, is currently one of the 3 leading exchanges on the African continent. And I think it's just next to the Joburg Stock Exchange. Our discussions today, which will be limited to 20 minutes, so that we can save time, 20-30 minutes. And whilst I will deliver the lecture, I will choose who would answer the questions, because I have discussants supporting me. So I'll take the easy part and leave the difficult part for the audience. Now, we need to understand and provide answers to what the key issues have been. The reasons for the current low level of activities in the capital market, because the reality is that that market is in coma. What factors, therefore, are inhibiting the revival of the capital market today? And what actions or interventions in the short term do we need to put in place to revive the market following the slump that happened in 2007-2008, whilst also balancing that short-term initiatives with the long-term goals of widening and broadening the market in the short to medium term. We cannot overemphasize the merits of a very vibrant capital market, particularly in the life and history of an upcoming developing nation like Nigeria. The capital market provides the mechanism through which investors, both individuals and institutional investors, pool or aggregate their wealth together for the benefit of the nation. It also helps in pooling the risks together and enables people to share the risks and the rewards that are inherent in the utilization of the funds that are so put together, whilst also putting together a risk management framework to address the concerns of the investors. It also resolves the spatial and temporal distance between the entrepreneurs, those who have large pool of funds, and I've said here that we need to develop and build a large pool of entrepreneurs within the Nigerian space. It also therefore helps in pooling their resources and combining them with economic actors who have capital surpluses. We tend to think about the capital market alone as if it's majorly, there's a misinterpretation. Because in the real sense of it, there are money market instruments that are also traded on the capital market. And as you would hear as I speak on, one of the reasons why the real capital market that we all talk about is not doing well today is not unrelated to the crowding out of money market instruments that are being traded on the capital market. There's no doubt in my mind that robust capital markets have played significant roles in the development of strong economies, and you cannot divulge the strength of an economy from the performance of its capital market. Any attempt to do so would result into misanalysis of the key problems of that economy. The Asian economies and the US are living examples of economies where the capital market have played significant roles in development of those economies. Now, what are the levers of the growth of the capital? Because when we talk about the crash or the need to improve the capital market today, it simply means that we acknowledge the fact that at some point it had been better than what it is today. We therefore need to go back to history to find out what drove the vibrancy of the market at those times when the markets were vibrant, and what went wrong. It is only then that we can attempt to provide solutions on the way forward. Let me say, without any doubt in my mind, and without any fear of contradiction, that the growth that happened between 2004 and 2008 were driven mainly by about 4 different items, some of which can be subsets of the others. We had structural reforms of the economy which started with about 1999, as a result of which the rate of the economic growth rate in the economy, that's the GDP growth rate, moved from 3 to 4% to about 7% from 2003. Those structural reforms were very fundamental, and they changed the platform upon which the Nigerian economy stood. That was a factor that levered growth in that particular period of 2004 to 2008. In addition to that, we had a banking sector reform, which led to minimum capitalization requirements around 2004-2005. That also further drove inflows of investment into the Nigerian capital market. Thirdly, the promulgation of the Pension Reform Act, of which I was a key player, also brought in over 600 billion naira of pension fund assets into the market around 2007. However, in addition to all this, we had massive importation of capital into the Nigerian economy because of certain attractions which were existent at that point in time. Are those attractions still there today? No. Why are they not there? We'll look at the reasons. And so, we saw a decline in capital importation from 2.6 billion naira, it went up to 3.42 billion naira, only to decline to $1.48 billion in 2009. The figures I just quoted for emphasis are dollars, please. In 2009, the foreign capital importation declined to $1.48 billion from the peak of 3.42 billion when the market was booming. However, the global crisis, the global financial meltdown, played a major part in the decline of foreign direct investments and capital importation into Nigeria. This declined by about 57% in 2009. But note that over a quarter of the total capital importation into Nigeria between 2007 and 2010 went into the Nigerian capital market, which means it actually had a fairer share of the capital market, capital inflows into Nigeria in relation to other sectors of the economy. From 2006 to 2007, there was significant growth and positive indicators in the market, only for those things to start declining from 2007. And I have some statistics here. The total market capitalization of Nigerian companies went down from 13.29 trillion naira in 2007 to 10.28 trillion naira in 2011. Of that segment, the banking sector, which is a very vibrant sub-segment of the Nigerian capital market, went down from 6.4 trillion naira also in 2007 to 2 trillion naira in 2011. Major declines. As a matter of fact, today, you have Nigerian banks trading on the Nigerian capital market at sometimes less than 1 time price to book, as against the situation even in Ghana or some parts of Africa, where you have banks and equities trading at sometimes over 2 times price to book. Arising from all these declines, the value of the index dropped from 33.35 points in 2006 to just 20,730 points in 2011, while the all-share index fell in 2011 alone by 16% as against the 19% growth that was recorded in 2010. Now, as the meltdown began, foreigners who were attracted into Nigeria by the superlative performance of the Nigerian capital market, and I think at one point the Nigerian capital market was rated as the most profitable market in the entire universe, and that on its own should have signaled to us that it was not a sustainable trend. All of us who are in the race to attract foreign investors into the equities market should therefore learn from the reaction of the international investors when the market went bust. The first thing to do is to pull the rug from outside the environment because they have to protect their own environment first and foremost. And I think as we go around the circle again, we should remind ourselves that what comes round goes round, and what goes round comes round. It's a circle that will always repeat itself, whether we like it or not. Now, as the global meltdown deepened, the foreign investors naturally began repatriating their funds by selling their equities at whatever price on the floor of the Nigerian Stock Exchange, simply to fill the holes. We need to understand that some of them also were leveraged in the funds that they brought into Nigeria to invest. And when you have leveraged funds, when there is a crisis, what the banks do, first and foremost, is to recall their funds. And when they recall the funds, you have no option other than to sell, sometimes under severe pressure, at prices that ordinarily do not make sense. And that happened at that point in time. There were also interventions and relationships with the pressure on the oil economy as the price of oil declined significantly. It moved from $147, that's the price per barrel, in 2008, to mere $33 in 2009. This therefore contracted the money supply that was available in the system, and the government therefore found it extremely difficult to defend the external reserve position. I'm trying to build a case because there's a relationship between the economic environment and the performance of the stock market. What this did, therefore, was that because of the reduction in the total revenue from the government, it was impossible for the government to defend the exchange rates, and so there was devaluation of the naira, either consciously or unconsciously. Now, the activities therefore dropped in the capital markets, and the fear of exchange rate losses on the part of the foreign investors drove them to panic and quickly move out of the market. The weak finances of the government during that period also foreclosed any opportunity to bail out the capital market because the main source of revenue, as we know, still remains oil. And because of the reduction in the price of oil, it was difficult for them at that point in time to bail out the capital market. Arising from all this, the capital market, which witnessed significant increases in margin loans, shed over 5 trillion naira in market capitalization in 2008 alone. The recapitalization of banks from 2 billion to 25 billion naira during the Soludo-led CBN era in 2004-2006 heralded a stock market boom as banks approached the market to raise new capital. We have since been told that, in fact, some of those capital were bubble capital that never existed, and yet they created instruments that were traded on the floor of the stock exchange. This regulatory-induced consolidation, therefore, fueled margin lending in several stocks, including banking stocks. And there were sharp practices, unless we don't want to admit. You had banks converting their depositors' funds into equities that never existed. Customers were made to hold equities that they never applied for. And I recall a particular customer of ours who also happened to be a friend when the bubble burst. and were trying to move against his assets. And he called me and said, look, Bisi, all banks made it too easy for me to get margin loans. It's part of your problem. If you had been cautious enough, you should have known that what you were throwing at me was much more in excess of my capacity. And the same thing happened all over. The rest, as they say, is history. And for example, the 5 banks that were bailed out by the central bank through the central bank intervention today have margin loan exposure of over 456 billion naira that were taken over by AMCON. Now, what were the key drivers of the bearish trend in the capital market? Let me summarize them. Today, we have bearish trends in the market. And what are the main reasons? I'll put them into 4 different buckets. We have a very weak macroeconomic outlook. We've heard from the Minister of Finance and the coordinating Minister for the Economy that we should be prepared for a recession. As the oil price dropped from a record of $147 per barrel to 33 billion naira, $33 per barrel, it's beginning to put real pressure on Nigeria's external reserves, and the naira exchange rate is beginning to be under pressure. This is a factor that is responsible, amongst so many other factors, for the bearish trend of today. Second, we have the contagion from the external countries with the rapid divestment of shares triggered by what we call the herd behavior. Investor A takes the decision to drop the shares, and you just see the other investors following that particular trend without even trying to find out why that particular investor is dumping the shares. That's what they call the herd behavior. This therefore led to a spontaneous crash of the capital market. It's similar to what you get on the traffic on the roads. Without knowing what the problem is, if you see just one vehicle trying to reverse, everybody assumes that there's a problem in the front. Everybody begins to talk, and that's a factor. Now we also have what we call the crowd psychology. Now after the sharp withdrawal of funds by the foreign investors, which arose from the hurried exits by the banks to plow back their margin loans based on failing conditions. Now, I did mention that because of the problem that arose from the stress testing of the banks, it was apparent and very clear that those market facilities were not supported by fundamental assets. And so the first thing that the banks did at that point, I'm talking of local banks now, not the foreign banks, was to recall those margin facilities. Unfortunately, those margin facilities were pledged against shares that were quoted, particularly banking stocks, oil company stocks, and so on. And so what we had was massive dumping of those shares on the floor of the stock exchange for banks to minimize their losses. The capital market therefore suffered a collective market exit behavior, also known as hedging. So I talked about hedging from the international investors. We've also seen it from the local investors, simply because they wanted to cover their position arising from the ongoing, at that point in time, stress testing of the bank's capital and credit portfolio. And of course, there were very rare and high profit margins that investors earned before the bearish trend set in. And so people still believe that so long as you don't get the kind of return that you were getting at that point in time, the market is still down. Not necessarily so. What we earned as returns on equity investments in those days, both as individuals in our individual capacities and sometimes some organizations, not First Bank, was not too different from going to gamble in a casino and coming back home with loads and tons of cash. It would be erroneous for you to assume that that will continue every day. I remember very clearly of a few people who sold almost everything that they had because of these perceived returns that they were getting from the capital market. Some of them live today to regret. And the basic principle of investment and risk management is that no matter how sweet it is, minimize how much of it you buy it. Even if it is food, no matter how sweet it is, limit your intake because it can be injurious to you. They just didn't know when to stop. People made so much money and plowed everything back into the same capital market. The cycle is coming again. It's not a prediction, it has always done so. And people who are wise today would learn to note that it is always important and necessary for you to diversify your portfolio. Make money, diversify, but don't keep everything in the same basket. And of course, lastly, there was very shallow understanding of the capital market. That is the fact, and that fact still remains today. I'm not sure that our stockbrokers also help matters. Because sometimes when you benchmark and attach your returns or fees to how much volume of trade you do on the floor of the stock exchange, the tendency for you sometimes, if you are a beneficiary of those fees, is to overlook the fundamentals of the market, even if you know. It is surprising to note that, in fact, some very experienced chartered accountants and chartered stockbrokers were not insulated from the crisis. And sometimes you begin to wonder, what did we do with the professional training that we had? Now, let me save time, please, so that we can. The current concerns for low level of activities of the market, because we've moved here now that at one point in time there were serious level of activities in the market, but it's becoming low now. Apart from all the global economic issues that I mentioned, there were evidences, and they are still emerging today, of widespread market abuses between 2006 and 2009. And up to today, I'm not sure that there is strict enforcement yet of the Code of Corporate Governance for employees and officials of public hotel companies. Unless and until we go back and put discipline and enforce strict corporate governance, those abuses will not stop. Insider-related abuses still exist. I'm not sure they've been eliminated. And those things were major issues also that accounted for the fall. We also have institutional and structural shortcomings, ineffective market regulation and supervision. We cannot run away from it. There was ineffective supervision and weak corporate governance even in the quoted companies. Now, what are the recent developments in the Nigerian capital market that contribute today to the low performance of the capital market? Because it's not just capital market alone. There are other activities outside the capital market that contribute to the poor performance of the capital market. Today, you get close to 15% returns if you invest your money in treasury bills. So, as the federal government continues to borrow, it's been increasing the yield on its borrowing instruments, and it's probably making those instruments much more attractive than investments in equities. These rates rise, therefore, in turn, increase the attraction of government debt instruments to both institutional investors and individual investors, and therefore has pushed the private sector out of the business of issuing bonds. And I did say when I started that the capital market itself is divided into two segments. The money market side, where you trade in money market instruments, and the real capital market. It's extremely difficult today, even when you advise governments and institutions, it's extremely difficult for them to come out today with bond instruments because of the pricing structure. When a risk-free instrument, risk-free in quotes, of a federal government gilt-edged instrument is offering close to 15%, you have to price into the instrument when you want to issue as a corporate organization the risk premium. The rate becomes so unattractive because of the fact that the government instruments are available in the market. We've not been helped also, the market has not been helped also by the decision of some of the quoted companies. I don't like to mention their name, but we know them. There are two quoted companies that have applied and have been delisted from the stock market. This has therefore further depressed the market capitalization on the floor of the stock exchange. I'll try to keep my presentation to the next 5-10 minutes so that we can wrap up. There's therefore a key benefit of a properly functioning capital market and its connection with the larger economy. We keep talking of deep decadence, infrastructural decadence in Nigeria. We should rather see it as opportunities for us to put together structures that will help us to raise financial instruments that can be traded on the floor of the exchange to solve the problem of infrastructure deficit that we have. It is noteworthy, therefore, that in the last 3 decades, Nigeria has witnessed a massive deterioration, steady deterioration in our stock of physical and social infrastructure, simply because we don't have the right capital market that can assist in structuring financial instruments that will be used in solving and creating infrastructures around us. There is therefore a very strong case for us to rejuvenate the Nigerian capital market for sustainable growth and global competitiveness. It goes beyond the returns that individuals get. It also helps us in building and creating a vibrant environment for us to live in. Now, let's look at even the composition of the quoted entities on the floor of the stock exchange today in relation to the Nigerian economy. Over the last 10 years, the GDP output of Nigeria has averaged about 6%. Now it's inching towards 7%, 7.1%. However, close to half of the GDP growth over this period is accounted for by agriculture. Now, agriculture is a good thing, but it's bad when you consider the fact that that type of agriculture that sustains our GDP is in fact subsistence agriculture. It's of what we call the rain-fed nature of subsistence farming, which means you just produce to feed yourself and nothing more. It's therefore not sufficiently developed enough. That agri sector, which is the main driver of our GDP, is not sufficiently developed enough to attract investment of a substantial nature. And that's a restructuring that we need to do if we want to move forward. You cannot have a major component of your GDP not providing organizations that can be listed and traded on the floor of the stock exchange. It's an anomaly. Therefore, the reforms of fundamental nature will need to be done in order for it to be able to attract investment to agriculture and eventually to have agro-allied companies quoted on the floor of the Nigerian capital market. In addition to that, the average growth rate of GDP is 6%. However, inflation is at least 12%, double digits. Therefore, thank you, negative growth. So it's nice for us to see that there's a growth rate of 6% in the economy. But when you discount that with the rate of inflation, it's negative growth. Exchange rate stability is also a prime concern for foreign portfolio investors. And if you're in their shoes, you'll be concerned. If you import today $100 million and you invest it in the stock market, at the point when you want to exit, if there is massive devaluation of the naira, don't forget your investment is in naira. At the time you want to exit, or you actually exit, and you need to repatriate your funds, no matter how much rate of interest or returns you have earned, if it is not more than enough to compensate for exchange rate loss, your negative investment yield, the investment yield is negative. And so, whilst it is easy for us to say it's the capital market, we can say that it's a well-interwoven arrangement in which the capital market is not totally separated from the rest of the economy. Now, what are the chances of exchange rate devaluation? Because it's important for us to understand why the foreign investors today are not in a position to invest as heavily as they did at that point in time. One, the yield on this financial instrument, the equities, are no longer as attractive as they used to be. Okay? In addition to the yield, the capital appreciation that we used to have in those days is no longer there. The fundamentals of the companies are still good. They are delivering what we will call normalized returns today. But let us not discuss it. We can't go back to the era of making one. I think there was a company there, a bank, that advertised 1,000% returns to shareholders. If you have Bonny Light crude, which is Nigeria's blend, trading at $128 around March this year, and has dropped steadily, and sometimes it was close to less than $100, it's important and imperative for us to understand that the extent to which the government can continue to defend the present exchange rate is doubtful. Therefore, currency volatility would further complicate the economy's ability to attract investments, as would-be investors would always worry that adverse currency movements might see them incur losses in their investments whenever they decide to repatriate such investments. Now, the concerns of the capital market investment, therefore, will be summarized in terms of returns on investments and inflation risk and the exchange rate risk. The 2008 era had very high return on investments that was high enough to compensate investors for the high returns that they were seeing. Therefore, we believe that there should be further reforms. I believe that there should be further reforms that should include availability of credit at the retail level. What we have done so far with the cleaning of the problem in the banking sector is to package margin facilities and sell them to AMCON. We need to understand that that alone does not solve the problem. The truth of the matter is that there is no liquidity in the hands of the major players. I stand to say, and I stand to be corrected, that I have done a sort of research, and I'm not too sure that a lot of people actually put their own personal monies into the stock market in those days. There was a lot of borrowing that went on. And because today we have a guideline on margin facilities that's been issued by central bank, quite rightly, because if you have the opportunity to know the rot that existed under the margin facilities, you will not blame central bank. So what you have to do is you have a margin facilities guideline from central bank that prevents banks from taking or giving margin facilities for anybody to acquire shares in banks. It has a history, okay? Now, we must find a way of putting liquidity back into the market. It's fundamental for us to move forward. It will therefore be essential that liquidity be returned to the system and the return of savings to the capital market in the medium term. Very fundamental. And I think the Honorable Minister for Finance had already indicated that the federal government was working on having a bailout fund to put liquidity back into the system. I also had the unpleasant experience of discussing with a big stockbroker, a very big stockbroker then, who came to me and said, you know what, the business is down. Most of the staff have been retrenched. This was a very, very vibrant stockbroking firm. He said, come and look at this building. Take it as a branch of First Bank. I will move to the boys' quarters. That's how bad it is for stockbrokers. We seem to believe that by taking care of margin facilities, we're taking care of everything. What about those who did not borrow, who invested their own funds in proprietary trading? They've lost everything. Even the margin facilities, what we're taking care of is the banking side of it. Nobody gave margin facilities without equity contribution. So the equity itself is gone. And I'm not also sure that there is forbearance on those margin facilities because they still have an obligation to repay those margin facilities to AMCON. And I'm not sure that the coupon rate on those margin facilities, even though they've been sold to AMCON, is zero coupon. So these are fundamental issues that we need to do. Now the way forward. We need to create incentives that will encourage the listing of telecoms and oil majors because these are attractive investments. These are sectors of the economy today that are doing very well. Unfortunately, the capital market does not have the advantage or benefit of reaping from the profitability of that segment of the market. Now, we made a fundamental error. I don't think, Honorable Senator Omowara is not here. I don't think the approach today of trying to coerce telcos into listing is the right approach. At the time when we gave them licenses, we had the option of building it into the license terms and agreements that they should be listed. We failed to do that. But a second opportunity is around. I'm aware that those licenses are or will soon be due for renewal. So this is the time for us, on the part of the government, to look at the possibility of ensuring that the listing of those companies are fundamental terms under the renewal of their licenses. We need to also launch a coordinated campaign to enhance the public confidence in the capital market. I started by doing the analysis of the beautiful lady I went to the market. It takes time to build that confidence. Part of the factors also that accounted for the crisis today is lack or low level of investor knowledge. What are we doing as a country to increase the level of awareness and understanding of the capital market? We still don't know. People still believe that the capital market is not doing well today because it has not gone back to those eras where we were doing 1,000% returns over a period of 5 years. It's never going to come. People should be educated well enough to understand basic factors that drive the market. One, that the returns will be moderate. And two, that no matter how attractive a particular stock is, don't concentrate, diversify your portfolio. We need to go back to the basic. And I want to challenge orekoya because this is your area. Investor education, very important. Market awareness and so on. Now, regulation. It is not just right today that you have so much uncertainties in the regulatory environment. There's so much confusion. And so we need to strengthen the institutional framework to check market infractions. And because I'm speaking as the group manager director of FBN, there are things I cannot say. But the reality is that we need to put our acts together. You need regulatory environment that is decent, sustainable, and can be trusted by foreign investors if you want them to invest in your market. They don't want to come to a market where they wake up today, they don't know what is going on in your market. Corporate governance framework needs to be strengthened. We need, let me be honest with you. I had the opportunity of speaking, amongst ourselves, and I spoke with the MD of AMCOM sometimes, about a year ago. And he said, look, the reality is that on their own roadshows, they went on roadshow, and it became apparent to them that foreign investors just don't believe the numbers that are posted by some of Nigerian companies. They just don't believe your numbers. That's corporate governance. So the adoption of IFRS will probably help in dealing with some of those issues. But these things, very minor things, but they count in whether people believe you or they don't believe you. And lastly, and I've said this before, we need to provide financial solutions to the high debt problems of the market operators. They are in serious debts. You need to enable them to come back to the market. Maybe under an arrangement where you give them long-term loans, subsidized interest rates, low interest rate, whatever it is, something has to be done to support them. And of course, we started the process of market makers. We haven't completed it. Market makers need to have access to what we call stock lending. The framework for stock lending has been designed. I'm not sure it has been completed. Market makers cannot effectively conclude their work unless they have access to financing, either leverage financing or equities. We need to do that. Now, I'm not unaware of the efforts being made by the present CEO of the Nigerian Stock Exchange for the revitalization. He wants to revitalize the secondary market in bond trading. He wants to pursue aggressively the dematerialization of documentation of securities. He wants to introduce E2E, that's exchange to exchange, trade automation, and so many other things. Now, these are very bold and audacious steps. The challenge is how soon and how well can this thing be coordinated and implemented. Currently, today, it's nice for us to say we should encourage more companies to be listed. Even within the listed entities on the Nigerian Stock Exchange, only, in fact, less than 10% of the listed equities are actively traded. That's a fact. So sometimes there's a popular saying in the banking sector that it's easier for you to cross-sell more products to an existing customer than to win a new customer. Business and logic. So if indeed, of all the listed equities, only less than 10% of them are actively traded, why are we not focusing on that segment of the market to increase the level of activity, even on the quoted ones? We need to broaden the product offerings also. We need to look at our statutes and look at investor-friendly statutes and rules that we need to adjust to expedite and deepen the conduct of business on the exchange. Forbearances and so on, regulatory stability, which I've mentioned. I don't want to waste too much of time, but let me talk about the pension industry. Today, the existing investment guidelines of PENCON allows up to 25% of pension assets to be invested in equities. However, the truth is that on the aggregate, only less than 10% of pension assets are invested today in real estate. There should be a way forward. We should find a way of also looking at government support to encourage PFAs to invest in that segment of the market without in any way putting at risk the pension assets. We therefore need to look for proposed amendments to the PFAs. I think there are amendments being proposed already to make sure that those amendments are finalized on time to address the fundamental issues that we are seeing. So there is a need to expedite action on the enactment of necessary statutes to have the changes proposed in the pension reform. We need to revitalize the secondary market bond trading. It's just not there. The major trading that takes place today is primarily from the primary market. Once you go to the secondary market, it's basically done over the counter. And so the platform for trading in the secondary market, and bond instruments in the secondary market, need to be finalized and implemented on time. The security lending framework, and of course, we cannot rely on the Lagos Stock Exchange alone. It started at Lagos Stock Exchange, we call it Nigerian Stock Exchange, but the reality is that we have invested heavily in creating an Abuja Stock Exchange. We need to finalize the reactivation of that stock exchange. Let me say here that because of time, I will just make one or two more suggestions. Let's look at the possibility of encouraging the Sovereign Wealth Fund to invest a certain portion of the fund in equities, local equities, rather than taking everything out into foreign countries. In addition to that, let's look at what we can do with the unclaimed dividends and possibly look at putting it into a trust fund to create some more comfort for the investors and take it away from the hands of the existing registrars and maybe some other. And lastly, why should we continue to charge value-added tax on capital market transactions in a market where we want to encourage further investment? I'd like to keep it short here. Thank you very much.